All right, Winning Wealthers, welcome back to the Winning Wealth Podcast. I'm your host, Jeff, with co-host Brock Mogensen here. Today we're going to be talking about commercial real estate predictions for 2024. Obviously, you got to take that with a grain of salt. Nobody has a crystal ball, but there's a lot of things going on from a macroeconomic standpoint and just from a growth trajectory standpoint that we're excited about going into 2024. So we'll talk interest rates, we'll talk inflation, we'll talk the boom in industrial asset class that we're so bullish on, and it's going to be a great episode. Tune in. Thank you. That's me in a nutshell. You're close too, but maybe we do that after. I don't think we were that close.
Let's maybe start with 2023, right, to give some insight on the past year quickly as well. I mean, so deal transaction volume, depending on which source you're looking at, down over 50% in real estate in 2023.
Undisputed down over 50%.
There wasn't a lot of, there was deals happening, but it was slow in 2023. We did 2 transactions in 2023. Yep. Not a lot of opportunity we saw out there, right? Of course, there's always deals in any market, but it was a down year for sure. Yeah. And that's majorly because of interest rates, right? I mean, interest rates skyrocketed in 2023. Yep. And pricing hasn't quite caught up yet.
Yeah, it was kind of like I've heard it called, and I've said it before. It's kind of like a staring match between buyers and sellers, like who's going to blink first. And there hasn't really been any need for sellers to sell if they have a great interest rate, right? And so the whole name of the game there is that you buy something with a great interest rate, you better add some fucking value. Excuse my French right off the bat here, but you better add some value to that property and increase the net operating income, get the rents up, streamline the operations so that when you do have to refinance, which we'll get into that, you're sitting in a better spot and you're going to be able to maintain that debt.
Well, that was a lot of what we saw, right? And talking to other investors as well, as just a common theme is there certainly was deals that were on the market for sale, but there was mostly sellers. They had a price, right? I'll sell for $3 million and I don't need to sell. If you can hit my number, it's an unrealistic number, I'll sell, right? And I think a lot of the deals, talking to brokers as well, that happened in 2023 were 1031 exchanges. Yep. All right. So people that 1031 exchanges, when you sell a property, you can take that cash and deploy it into another property and not get taxed on those gains. So of course, if you take into account not having to pay the taxes, you can pay a higher price than the individual investor is paying cash for it, right?
Exactly.
So there was certainly deals and people that are paying cash for deals, kind of different, looking at deals a different way, but the traditional way of leveraging banks for 75% of the money when rates are 7 to 8%.
And shot up over 2 years, the fastest, I think, interest rate hike, in the last 50 years or more. Basically, that just, it made it so that there was uncertainty in the market. And like you said, I mean, the deal transaction was down 50%, some as high as 80%. And, really just, it didn't allow for, a lot of compelling events to create a transaction, right?
I agree. So, all right, let's with that being said, let's go into some predictions here for 2024 and kind of some of the tailwinds you could say for opportunity.
Yeah, well, I think there's still some headwinds, but there's definitely some tailwinds, that are coming in 24 and 25. I mean, the first one and the main point is there's a shit ton of commercial debt coming due. In 2024, there's $659 billion in commercial loans that are slated to mature, and in 25, there's $539 billion. So over the next 2 years, $1.2 trillion worth of debt will mature. And so groups are going to have to figure out, what they're going to do with their properties. If they haven't added that value, they're probably going to be looking to sort of fire sale, or get out of it at least what they got into it for. And it's, that is certainly going to create opportunities.
Well, let's unpack a little bit debt maturing. What does that exactly mean, right? So that means that if someone traditionally in commercial real estate, you're usually getting, on average let's say a 5-year term, right? 3, 5, 7, 10-year balloons they're called, right? So,
or it could be short-term debt.
Could be short-term, right? Yeah. So, but generally you're on some sort of schedule like that. In commercial real estate, you're not going to get, like with a house, you'll get a 30-year term, right? That's not really, there's certain vehicles you can do that in commercial real estate, but it's not the norm. So when he says matures, that means the bank's going to need that money, right? So if you got a loan and you have $2 million loan with the bank, When that loan comes due, and that's what I mean by a bunch of this maturing over the
Yep.
next couple of years, the bank has the authority to say, hey, you owe us $2 million. I'm gonna need that money, right?
Yeah.
And we don't want to renew the loan, or
Yeah.
the appraised value is now lower, so
Exactly.
you got to have the cash to cover it. Otherwise, you got to go out and fire sale it, right? If you owe $2 million to the bank, but the property's only worth 1.8 million because you overpaid for it, you didn't add value to it, you might have to go out and fire sale it for 1.8 million, and then stroke the 200K out of pocket just to get the bank off of it.
Exactly. And the difference between a 3% interest rate on your mortgage and a 7% interest rate is really high. That makes for that's a whole different world, right? So to be able to what we call service the debt or be able to afford the debt, let alone cash flow and put some money in your pocket every month, that's what we were talking about, where you got to be able to add value in some way, shape, or form to those deals before that loan matures and the bank's calling and saying, hey, it's time to pay up or
Pony up. Yeah.
pony up that dough.
Well, I think so many people, when rates were, at 3%, great. It was a great time to buy, right? But you still have to buy right. I honestly think there's also a geographical component too as well.
For
I think
sure.
certainly like southern markets or the hot markets, right, that everyone was investing in,
Yeah.
people were paying insane prices, right?
Yeah.
Cap rate wise, people are paying 3 caps,
Yeah.
right? And it's like, okay, like you said, when your interest rate, your mortgage payment doubles,
Yeah.
and you didn't add the value to the property, you didn't increase the value of it, the cash flow doesn't support it, right? The cash flow is already tight. People were buying it when it's at 3% rates.
Yep.
Now they're at negative cash flow.
Yep.
And unless you have deep pockets and you can afford just to write the check in cash to keep it afloat, you're gonna have to sell.
Yeah. Yeah, it's crazy, and there's other like you were saying, regionally, and different asset classes have different sort of tailwinds and sort of growth trajectories. But the main thing is in commercial real estate, and real estate in general, interest rates drive the market, right? So that's the biggest point, and we're likely to see some opportunity because of all this debt coming due in the next 2 years. And so, but to your point, yeah, if there's a lot of population growth, if you can figure out a path of progress, like an area that's just booming, maybe that rent growth will help you, but you still had to be able to go in and do the things that you need to do to capture that rent growth and to improve the NOI so that you can
Yep.
sustain that debt.
And a quick on that topic, plug almost, right, for why we prefer to invest here in the Midwest markets, right? And we invest in the greater Milwaukee area. Is there's things called the boom and bust market, right? It's like I was saying, your Tampa, Florida's, your Texas markets, a lot of these markets that were booming during that time. You didn't have to do anything. You could have bought it and doubled in
Phoenix.
value, right? Like, yeah, a lot of
Yeah.
these markets people are familiar with are great during those times, but
Yeah.
during the bust time, which is, the prediction of where we're heading here, it's not so great. Whereas with a market like here, it's much more stable.
Yeah, they
The
call it
Milwaukee
a
area,
linear market.
linear
Right?
market, more stable, right? We experience, of course, during the boom times, we're going to see, this while the other markets are seeing this, right? But vice versa as well. When they're going straight down,
Yeah.
we're going to see a slight downward.
So our whole business is based around trying to achieve predictable cash flow, right? And we want to be able to have that predictable cash flow while we only invest in deals and buy properties that are going to cash flow on day one, and then from there we can try to pull these value add levers and do different things to the property to increase that cash flow. But in a lot of those other markets, they're buying and not expecting the cash flow for a couple years, right? And then have to add the value that way. But you're totally right. We like even though southeastern Wisconsin doesn't have the greatest weather, we got bigger bills for snow plowing and different stuff like that, and it's rough on the roofs and all that. But at the same time, it's like you're buying it at a much better cap rate going in, and you're not expecting these wild swings, right? That just introduces, instability, complexity, and could put you in a really tough spot. Versus if you're buying something in a linear market like Wisconsin, Ohio, Indiana, Minnesota, those Rust Belt states, Pennsylvania, those that have that more linear cash flow or a linear market to. You're not going to get as much appreciation if you don't, force it, but you're going to be able to sleep a little bit better at night.
We also look at, I was reading a report the other day about apartment rent specifically.
Yep.
And a lot of these southern markets, like we're talking about, are actually seeing negative rent growth
Well, yeah,
because they went up. They were going over 20% year over year. They're just going up, 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 and up. Milwaukee actually ranked. I think it was in,
it's
within the
like
top
third, I
five as
think.
well.
Yeah,
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 of rent growth,
yeah,
right? So it sucks for those that are renting right now. But on the investment side,
yeah.
it's great, right? So I think you're starting to see a switch of a lot of investors are starting to actually prefer some of these boring
Yeah.
Midwest
Well,
markets.
so what happened exactly? But what happened was with the low interest rate climate too, and this always happens with developers, right? It's just a it's peaks and valleys, and with that basically free money, builders are going to build, and so you see population growth. People are moving to Phoenix or Tampa, whatever, right? They're going to go overbuild. They're going to build a shitload of it. Well, what happens when all this new stuff comes online? The B class guys rents get compressed, right? So that's where you're seeing the rent declines in a lot of these markets.
Yeah, certainly a lot of markets that I see contradicting data that's says the overbuild versus not building enough. I think a lot of it is can be theory, but so let's talk about as well capital markets, right? So that's obviously a huge factor as well heading into this next year. One thing I would start with talking about is as well as interest rates going up, there's overall sentiment from banks lending right now is down. A lot of banks are kind of halting ships and saying,
Mm-hmm.
hey, I've talked to several banks in last year, 2023, that said, hey, we're done lending on
Yeah.
commercial real estate for the year. Like, unless you're a huge client with us already, we're not
Mm-hmm.
taking on new business, even if the deal's great.
They shut the
We're
doors.
just kind
Yeah.
of being conservative with everything that's happening with banks, right? And
Yeah.
liquidity squeezes everything that's happening, right? A lot of banks are just becoming conservative, and that plays into as well. Interest rates are, of course, an important factor when you're looking at getting a loan from a bank. But there's also, amortization schedules, leverage, right? Like leverage
Yep.
is coming down,
Yep.
and that affects everything else.
Yeah, just overall disruption in capital markets is kind of the second point here. There's still elevated inflation. Just last week there was strong jobs data that was released, but given that interest or inflation went from up to 9% in the summer of 2022, it's now down back in the 3% range, which is more normal, right? But there's a lot going on. There's an election year. The Fed has currently penciled in 3 rate cuts in 2024. So there's this disruption in capital markets presents opportunity for those that are out looking for it, right? Could be good, could be bad, in certain properties, but I believe because of the uncertainty that there's going to be some opportunities that pop up because of that.
Certainly, yeah. I think just again to highlight the people that you didn't buy right over the past couple of years, you didn't buy at the right price, and as well as operating these properties. Even if you might have overpaid a couple of years ago, if you were a good operator and you added value to these properties,
Yeah,
you're going to be all right, right?
you
I
can
think
get away with it.
you can get away with it, but I think those are the ones that are going to be affected most. And I think, as far as as we're recording today, have we started to see a shift in the market yet, right? Like as we're talking about opportunity, has there been any like we're seeing sellers needing to sell? Personally, not a ton. I'm starting to see more concessions on sellers.
Yeah,
Okay, we offered him a property that he was willing to come down $1 million off purchase price. That
yeah,
was one of the few scenarios we're starting to see it come down. But I'm not personally seeing where people are like, hey, we need to sell. No matter what the price is, like we're going to sell.
yeah. No, no. It's like a big ship turning, right? It's slow to get there, but we're seeing more concessions, but not really like sellers that are their hands are forced, and so it's not quite a it was a raging seller's market for a long time and buyer's market, and then and so it'll ebb and flow obviously, but we're not there yet where it's a huge seller's market or buyer's market.
Yeah, I agree. So maybe we could talk about some like industry specific asset classes, right? And we can touch on a few, and then maybe we go into kind of where our thoughts are on what we're investing in and why we think
Yeah.
it's the right vehicle. I think the one that's obviously been getting hit the most over the past couple of years is office.
God, yeah.
I think everyone knows that, right? The headlines is every other day you see another big office building that went bankrupt. And it's because obviously COVID and the whole transition from work from home. You're starting to see that flip where people are actually coming back into the office now. But I think, we got hit, we got hit with that whole thing, owning an office building. It's tough. My personal, I think that office isn't going to disappear entirely, but I think it needs to be the right office, right? The right location, newer, nice
Yeah,
amenities, kind of an experiential office asset, and not just like an old dilapidated building that
for sure.
has a, a shitty office.
Yeah, I mean, COVID just accelerated what was actually happening with technology, right? When, if a business looks at their balance sheet, a lot of times their biggest expense is their rent that they're paying. The footprint that they have of offices across, multiple locations, right? That's one of their biggest expenses. And so if so it's obviously going to be sticking out to the CFO like, hey, what can we do to reduce or optimize this space, right? Can we get rid of a lot of office space and still keep, sort of more like or co-working space, get amenities there. We want people to be able to come into the office, but we know with Microsoft Teams and Zoom and Slack and all that, like you're able to get so much done remotely too. So I do think we're going to see people coming back to the office more. I agree that there's going to be more amenities in offices to get people to come back. But I think that hybrid work's never going away, right? Like it's just not gonna. The tools are there. It's easy enough. You can streamline and optimize things just from from your home office. And people don't want to. Nobody like. There's people that want to go back into the office, and have that sort of community and that environment. And there's benefits to sort of water cooler talk and being able to have the culture of your team right there in the office. However, nobody wants to be forced to go in. Like your ass has to be in the seat at 8 a.m. and you're not leaving until 5. You get 2 pictures up here in the cubicle and that's it. Like,
I live that
sorry.
life.
Yeah, you live that life. Like nobody wants that.
It's a nice office though.
Yeah,
Nice
it's
lunch.
yeah. Hey, thanks for lunch. But
So asset specific, I'm just looking down at this graph. I actually read this morning. It's a really interesting stats. So
shout out to CRE Daily.
yeah, it was on there. It's a great newsletter, by the way, for you're looking to learn more about commercial real estate. So it talks about outstanding distress and potential distress. And of course, the biggest asset class with the most outstanding distress is office, right? So there's $34.5 billion in outstanding distress is what it means in office. But the one highlighted as the most potential distress is apartments at 67.1 billion.
Yeah.
So it's kind of interesting, and this article kind of talked about as well. We're talking about the markets, right? The southern markets and these kind of more booming markets are going to see more of that distress.
For sure.
But it's interesting to kind of see that flipping, and then to also highlight the one with the lowest amount of distress on both sides is industrial.
And that's a good segue into why we're doing what we're doing. And so we saw so many. There was just a craze for buying multifamily, and I do love apartment buildings. I do believe that America is becoming more of a renter nation. I believe that you're investing in basically something that people have to live in, right? But you need to be a very skilled operator to be able to manage the expenses and to add the value of those properties. And I think during the time of very free, cheap money, a lot of groups went out and bought these apartment buildings and didn't really realize what they were getting themselves into. And they were just chasing that, hey, there's population demand, people are moving there, I'm going to buy that. And then a lot of people are kind of getting in over their heads. But specifically, why, and we kind of realized that we were buying apartment buildings at first. And then sort of as we got better and better over the last, 5 years or so, we started to narrow in on industrial as an asset class because we were solely seeking, where do we get the most predictable cash flow, the most predictable revenue, so that we can sleep at night and find opportunities. And that's been industrial for us. And so you want to talk through some of the reasons why we like industrial?
Yeah, for sure. So I think, we can talk through why we like that asset class specifically and why we think there's opportunity in 2024,
Exactly.
which has led us to what we're doing in our business right now, which is kind of restructuring into a fund model where we're going to go out and raise a bunch of money and be prepared to deploy it over the next 1 to 2 years into these distressed assets that come available. So, we could talk first about the e-commerce boom, right? And how that translates directly into industrial. Obviously e-commerce blew up during COVID and everyone's ordering stuff online and that trend's going to continue to grow. I mean,
Yeah.
don't really see that
15%
trend
year over
reversing.
year for 5 years. Like people I get personally, right? I mean, I get everything. I get pretty much everything sent to me directly online, right? I went to a store to check out some new boots And I was
Industrial boots.
yeah. I'm an industrial guy. I gotta go. I gotta go. I'm not the fashionista. All right. I'm looking at these warehouses. I want to be suited with them nice boots. But I go in there and I'm like, I was like, there's a couple different styles I wanted to check out, and they didn't have any of them. And the guy's just like, yeah, honestly, we got. And it was around Christmas, to be fair, but. I mean, there was just not a whole lot of inventory, and so I said, you know what, screw it, I'm just going to buy it online. Most places will let you, if you buy two pairs, you can send them back for free, whatever, right? And every company out there is trying to figure out how do they grow their business online, because you can reach so many more people, right? And that's all through e-commerce, right? That is not going away at all. It's only going to continue to grow. And how does that affect industrial? Well, the industrial asset class is it's manufacturing, it's warehouse storage, it's supply chain, right? So there's as this last mile delivery becomes more and more a part of our everyday lives. Like I needed new protein. I could probably stop on the way and grab a protein, but I saw it today. I buy it now, and it'll be at my door between 2 and 6 p.m. today. I'm like, well, I don't even need to take time out of my day to stop, because Amazon's just going to get it to me. And so people that are building on Amazon, or building on, or building out their e-commerce general and e-commerce channel in general as a business, they're going to need places to store those goods, and particularly, ideally, close to, their customers.
And it's also the trickle down effect of that, right? So it's not just the warehouse that's storing the boots. It's the other parts that go into shipping that, right? Like we have a warehouse space that they refurbish pallets, right? And what do things ship on cargo and on trucks? On
Exactly.
pallets, right? So there's so much other things that go into supporting e-commerce, not just the physical product.
Exactly. It's the whole supply chain, right? And that's one of the things. So another aspect of why we like industrial, both nationally, but also specifically here in southeast Wisconsin. But there's this onshoring, reshoring movement. Back in the 10 years ago, or whatever, like there was a big movement to move your operations from these big companies, move them overseas for really cheap labor. But they realized, particularly during COVID, so many supply chain disruptions. Shit was taking longer to get to where you needed to be, and it just backed up the entire supply chain. And now they're realizing, wait a minute, if we bring our operations back closer to, the United States, to our biggest customer base, we're gonna, even though we're paying more for labor, than for, say, manufacturing something in China or Asia somewhere, you're still going to be able to capture less leakage in your supply chain, right? And so you happier customers, less revenue leakage throughout the supply chain, and overall that'll impact your bottom line. So there's this big onshoring, reshoring movement, and what they're doing too is finding places that are what we call tier two markets. So or not just we call them, that they're called tier two markets. So they're trying to find tier two markets that are closer to tier one markets, but have an availability of a labor force that's cheaper. So, for example, Wisconsin, southeastern Wisconsin, Milwaukee area, right? It's a tier two market. It's just north of Chicago, right? It's cheaper than having your operations down in Chicago. It's cheaper for your employment base to buy a house, less taxes for your business, less taxes for your employees. And guess what? You're close enough. So you're able to, the worker to business ratio is a lot more favorable in these tier two markets, which is as the onshoring and reshoring movement accelerates. And I think with the election year, that's even going to be something that's talked about even more.
Well, there's the whole Made in America thing as well, right?
Yeah.
Right. So that's obviously a big movement. Is not necessarily even just the logistical side of it, is
Quality.
The quality, and being able to say Made in America is obviously a big movement.
It's hard to do quality control on operations that are getting, built by kids in China, know?
Yeah. And I think so, as well as talking about tier two markets is, you might be thinking, okay, like an Amazon warehouse, like how I'm not going to be able to buy an Amazon warehouse. But, Amazon announces they're going to open up some 1 million square foot facility.
Yeah.
There's going to be another 400 or 500 square feet, 500,000 square feet that needs to support that infrastructure, right? Is
exactly
one big business moving, whether it's an office or whatever the use is, other warehouse space needs to be around that to support that business.
100%, right? And that's just population growth in general, or business coming in. Microsoft's building a huge data center in between in our market in southeastern Wisconsin, just probably 40 minutes, 50 minutes north of Chicago, in sort of Racine, Kenosha area. And there's just an effect that there's more. You're going to need more space around that building because there's just more goods and services that are going to be needed to provided to that business there.
Yep.
And so, the thing is, there's not only are builders being more cautious because of higher interest rates, going into 23, 24. Building has slowed down across all asset classes, just like transaction volume has slowed down. So we were in this phase of like hyper growth of and potentially overbuilding. Now we're kind of in this phase of like, well, we're not really prepared to put the shovel in the dirt and really pull the trigger on building more. Only certain groups or the biggest groups are doing that. And even if you look at industrial development, most of the focus, a disproportionate share of the focus has been on building big, like 150, 200, 250,000 square feet and above, like Amazon facilities that are beautiful, A-class, and they're awesome. But, what that's done is it's pushed rental rates up for the smaller, flex industrial warehouse space that's 20 to 100,000 square feet. And our kind of buy box is looking for deals that are 20,000 to 150,000 square feet, too big for the individual investor to just go buy themselves, but too small for bigger institutional money. And it's something that we feel really strong about continuing that trend in 2024.
And just to highlight that, I mean, yeah, everyone sees it wherever you live, right, is these big box warehouses going up. And of course, there's going to be need for those spaces, but there's always going to be need for the smaller warehouse as well, right? A business that's, doing $1 to $10 million in revenue.
Exactly.
They can't afford that big space, right? They need 30,000, 50,000 square feet,
Yep.
right? And eventually their goal is to grow into that bigger warehouse, but as they get to that scale, right, they need that space. So that's where, you look at vacancy levels, they're lower in the 20 to 150,000 square foot space compared to 150K plus.
Exactly. So I haven't found anything, the premise of our fund is buying, multiple, industrial properties that are, call it average 50,000 square feet and, in a triple net lease format, right? So you're protecting. A triple net lease means that all of the expenses are pushed onto the tenant and their responsibility. So as insurance costs go up, as maintenance costs goes up, right, we're kind of insulated from that inflationary cost, right? So in times of high inflation, a triple net lease in an industrial property where we find that there's more demand anyways, makes a whole lot of sense. And that's why we've kind of, that's the whole thesis behind what we're trying to do in this business.
I would talk, next talk about the sale leaseback stuff.
Yep.
I mean, I think this is where I'm most bullish on in 2024, specifically within the industrial space, is a sale leaseback. So we've probably explained this at some point in the podcast, but essentially it is, there's a business that owns the warehouse, right? So they're doing business, they own the warehouse, and they sell their warehouse to an investor. So the investor comes in and they'll buy the warehouse and retain that tenant on a, it could be a 3-year, 5-year, 10-year lease, whatever, that's what you negotiate. But for the business, it allows them to have a liquidity event.
Yep.
Right. They don't necessarily have to go to the bank and borrow money at 10%, 8%, whatever it's at.
And even in those terms, like right now, there's a limited supply of credit because banks, what you were talking about
Go back
before.
to the capital markets.
Yeah, exactly. Disruption in the capital markets. Banks aren't looking to lend as much, right? Whether that's in real estate or business, they're being much more cautious. And so you're totally right. If I want to invest, say I own a $5 million property and I want to invest back into my business because I see an opportunity to grow the business. I'm in the widget business, not in the real estate business. It makes a lot more sense to get a fixed, stable operating cost through a lease, take that $5 million, inject it into your business, and you can hopefully grow the business from that standpoint. Also, too, a lot of companies are changing hands. Baby boomers are growing up, are growing older, looking to retire. Some of these companies they're starting to look to position themselves to be sold. It's a lot easier to sell a manufacturing company that doesn't necessarily own the real estate too. The private equity firm that might want to buy that company doesn't necessarily want to have that real estate on their balance sheet.
take it
They
off,
just
yeah.
want to buy the business.
Yeah, I think the other side of that too is if the business is in a point of pain too, right? Not only from a growth perspective, is maybe they need that $1 million to float the
Continue
business or
operations.
continue to pay payroll, right?
Exactly.
And the bank's not going to lend to them because, you know, their numbers aren't great.
Exactly.
Of course, you know, as a buyer investor, you're going to do your due diligence on the tenants to make sure they're strong. But, you know, we're able to negotiate on our end, right, as the investor, a lucrative deal, right? We can negotiate all the lease term. It's a blank slate, pretty much,
Yeah.
how to negotiate this deal.
The sale leaseback is, in my opinion, it's the best way to engineer a win-win deal for everybody involved. Like you're helping the business out, solve, you know, a liquidity crunch potentially. You're helping them get, you know, be able to invest back in their business and get real estate off their books. And we're able to negotiate a deal sometimes at a 10 cap or higher, where we can make a spread on you know, on the and just engineer a really nice cash flowing deal with a solid tenant, and then also have time to prepare. You know, if that tenant's going to be there for 3 years and we know that they're going to be out, like we can really get the property ready to be marketed in 3 years and have a full, you know, 18-month or 12-month, you know, leasing cycle ready to get a new tenant in that building.
Yeah. And I think we've done 3 sale leaseback deals now, and it's been a lucrative part of our business. And, you know, like you said, we kind of transitioned over the industrial side about 2 years ago, and it's been pretty much all the transactions we've done over the past few years. So I think, I mean, those are really the main reasons, highlighting of where we think opportunities coming in 2024. And again, that's, you know, reflects in what we're doing in our business and kind of pivoting over to a fund model where we're really going all in on this asset class and our theory of opportunity coming. And, you know, hopefully we're going to do some deals in 2024. Thanks for listening to the episode where we predicted what's going to happen in 2024 and why we're bullish on buying real estate assets in 2024. Some of the highlights, you know, we talked about capital markets, all the commercial real estate debt coming due, and why that's going to provide some tailwinds if you're on the right side of it, and potentially headwinds if you're on the wrong side of it. And we also, you know, went through our plan for 2024 on restructuring our business and really capitalizing. So be sure to follow along. If you want to learn more about what we're doing on the investing side, you can go to smartassetcapital.com. Please like the video, comment, subscribe. We're really trying to grow this in 2024 as well. So if anyone can find value out of this, we'd appreciate you sharing it with anyone. Thanks, and hope you listen again.
Smash the like button.